Good. So if you look at this particular question, you are required to prepare financial statements. So the financial statements here, we are going to start with the preparation of income statement. So we've been given a trial balance. We have been given a trial balance. The first thing we are supposed to do, ensure that your trial balance is actually balancing, because for any adjustment you're going to make from the additional information, you must debit one account and credit the other account. You must debit one account and credit the other account. Now let's do it together. Confirm whether the trial balance that has been given to you is actually balancing by comparing these results. So you come and compare the total here. You come and compare the total here. It's included to this point. Compare the total here. And as you can see, our trial balance is actually balancing. So from this point, we are now sure that for every transaction you're going to make down here, we must debit one account and credit another account. And therefore, at the end of the day, our accounts will be balancing. Good. Now, let's look at this. The first thing, we are told that the company maintains a gross profit margin of 20%. As at 31st of March 2023, accounts receivable balance included 250 due from a customer who has been declared bankrupt. The allowance for doubtful debts is to be adjusted to 5% of the accounts receivable as at 31st of March 2023. As at 31st of March 2023, administrative expenses accrued amounted to 175,000, while prepaid selling and distribution expenses amounted to 75,000. The company paid interest on debentures for the year ended 31st March 2023 on 5th of April after the end of the financial year. Depreciation is to be provided as follows: 2% per annum on cost, fixtures and fittings, 10% per annum on reducing balance. The company's director proposed that the preference dividends be paid. A dividend of 10% on ordinary share be paid. Shillings 2,500 be transferred to general reserves. Good. So you're required to get the value of inventory as at 31st of March 2023. Today, we are going to start with getting the value of this closing inventory. For us to get closing inventory, look at what we need to use. Look at what we need to use. So we're going to have the structure of income statement here. Income statement. So our income statement, we need to have this column. We need to have this column. So we start with revenue. We have revenue. We have revenue. Do we have revenue? Do we have revenue amount? This space is too big. Let me reduce it. So our revenue here, in some cases, you'll find them combining sales and revenue. I mean, yes, actually, this is the revenue. Sales stroke purchases. So what are they trying to test there? You should be able to understand that when you have sales and purchases, sales will be having a credit balance, purchases will be having a debit transaction. So that's why if they combine sales and purchases within the same place, you just know the debit one is the purchases, credit one is the sales. So our sales here is equivalent to 120,000. Now that everything is in thousands, then we come to cost of sales. Or even before you get to cost of sales, Do we have anything affecting revenue? That is return inwards. We sold goods, but our customers have decided to return goods to us. Do we have return inwards? It is not provided here, right? We only have return outwards. So return inwards is missing, and therefore this revenue becomes the net revenue or net sales. So to this, we need to deduct cost of sales. Cost of sales. Our cost of sales here, we are going to have opening inventory or opening stock. Then we add purchases. Then to this, we need to add carriage inward. And of course, we need to add, less return outward. Then we'll be able to get what we call cost of goods available for sale. Cost of goods available for sale. So let's get cost of goods available for sale. Let's get cost of goods available for sale. Cost of goods available for sale. Cost of goods available. Oh, this one's supposed to be here. Is it somewhere there? Good. So opening stock, were we having opening stock anywhere? Opening stock, we have been given inventory as at 1st of April 2022. Now that the financial year of this company is ending on 31st of March. And for this year, it is 31st of March 2023, which means the next date of the previous month is the start date of this financial year. So that is April, 1st of April 2022. Our inventory is here. Opening inventory, we add purchases. Do we have purchases? Yes, we have it here. To the purchases, we add carriage inwards. Any cost that was incurred to transfer goods into the company, carriage inward will be forming part of cost. But carriage outward is an expense. Carriage outward is an expense. Right? So you don't say that now carriage outward is the cost incurred to transfer goods to the customers. We now put it under revenue. No. It will be an expense. But carriage inward is forming part of cost of sales. Then we less return outward. Return outward, you purchased goods, but due to one reason or the other, that is maybe wrong package, wrong quantity, wrong quality, you have decided to return these goods to your supplier. So do we have return outwards? Yes, we have it here. Then let's get cost of goods available for sale. You have your opening, you've purchased some, you've incurred some cost, you've returned some. So when you get the summation of everything here, this is the cost of goods available for sale. To the cost of goods available for sale, we need to less closing stock so that we get what was actually sold, the cost of what was sold. So our closing stock here, our closing stock is not given, is unknown, right? So you can put 0 because we don't know that. We don't know that figure, we can put 0. We can put 0. Now, after putting 0, we need to less closing stock so that we get cost of sales. So cost of sales is equal to cost of goods available for sale minus closing stock. So this cost of sales, we can decide to put it maybe here. We can decide to put it there so that we now get gross profit. How do we get gross profit? Gross profit is equal to revenue minus cost of sales, right? That's what we have. Now, the examiner gave us something about gross profit margin. Gross profit margin is equal to gross profit divided by sales value or revenue divided by sales. Gross profit over sales. Gross profit over sales. So the gross profit margin given by the examiner is 20% under additional information number 1. But let's see what we are having as per this question without the closing stock value. So it's going to be equal to gross profit divided by sales or revenue. When you do that, you are getting 0.05, which when converted as a percentage will give us 5%. So we'll be asking ourselves here, what are we supposed to do to the closing stock so that we get gross profit margin of 20%? When you are doing paper-based exams, you could have applied that long procedure, trial and error. But here we have this powerful function or concept called what-if analysis. So when I go to data, what-if analysis, goal seek will enable us to do that. So our intention is to change this gross profit margin to be equivalent to what the examiner has given us, which is 20%. So I'll come and say, I want to set gross profit margin to what value? To 20%. By changing which item? Remember, we have one unknown item here. We do not know the value of that particular item. So which cell are we changing? Which item are we changing? Or in other words, which item are we looking for? Which item are we looking for? Somebody to help us. Which item are we looking for? Which item are we looking for? Which item are we looking for? We are looking for closing stock. Remember, we just placed 0 here, but we do not know the exact value of our closing stock. So I want to set my gross profit margin to 20% by interfering with the closing stock here. So by changing which cell? By changing the cell where we have closing stock. When I confirm this, I'll be able to get the value of closing stock to be equivalent to, our closing stock is equivalent to 18,000. So when I confirm this, my gross profit margin changes to 20%, which is equivalent to what the examiner gave me up here. So having done that, I'm actually done with this particular question. So I've been able to get gross profit, closing stock, the value of closing stock. Good. After getting that, I even don't need these other items. I even don't need this now. I've been able to calculate what was required. Good. What if analysis? Where is 18,000 coming from? That's what you are looking for. Lillian, that is what you are calculating. That is what you are calculating. We have said this closing stock value was not given. We had decided to put 0, right? And this is what you are getting. So what should we do to closing stock for us to get gross profit margin of 20%? I've said somebody will be coming here and putting 4,000 to test. It is 8.33. I need to increase this figure to 10,000. It is 13. That is still less than what is required. To 23. It is now more than what is required. It is around 20. 19. It is slightly above what is required. So that trial and error is what we are trying to use what if analysis to help us solve. So you go to what if analysis, goal seek. I want to set my gross profit margin, which I'm sure is supposed to be 20%. So I want to set that figure to 20% or 0.2. By changing which cell, this is the figure that I don't know. Remember, you are using trial and error here. You've placed 4,000, 23, 19. So this is what I want to change to get the right figure. Then you confirm. So ukifika hapa, Lillian, you confirm. As you can see, then even before you confirm, you can see we have 18,000 as the exact value of closing stock. At this point, it is now showing us gross profit margin to be 20%. So that's how you deal with it. That's how you deal with it. Now, having done that, I've said we don't need these other items now. So after gross profit, do we have any other income? Any other income? Any other income? Any other income? So any other income here can be investment income. It can be rental income. It can be decrease in provision for doubtful debts. So do we have any other income here? Any other income from this particular question? Go to the credit side and look for any other income. We have discount received. Discount received. Discount received. We have discount received of how much? Discount received 325. Any other income? Investment income, rental income. So another thing that can bring in other income or expense is the provision for doubtful debts. So do we have provision? If it is an increase in provision, I mean decrease in provision, decrease in provision will be an income, right? So let's look at it. The provision that was given, we are told down here that the allowance for doubtful debts is to be adjusted to 5% of the accounts receivable. So let's look at 5%. 5% of the accounts receivable. This accounts receivable, it should be net of the accounts receivable. Now, our accounts receivable as at 31st, some information is given down here. Actually, the first thing here, as at 31st of March 2023, accounts receivable balance included 250 due from a customer who has been declared bankrupt. So we have 8,250, including 250 for someone who has been declared bankrupt. So we delete it. We remove it from the receivables account. So once that is done, when you calculate 5% of that, you are getting 400. What was the provision at the beginning of the year? Allowance for doubtful debts at the beginning of the year was 450. But the one we are having now is 400. So is it an increase or a decrease? It is a decrease in provision from 450 to 400, which means decrease in provision is an income. It has decreased by 50. It has decreased by 50. So decrease in provision is an income. So what is our total income? Total income is equivalent to 24,375. So are we together up to that point? Are we together? Are we together? Are we together? Are we together up to that point? Which part are you not getting, Lillian? Which part? Which part? Which part? Which part? Which part are you not getting? Which part? Which part? Please let me know. Let me know. Let me know the part that you're not getting. We're talking about two accounts here. We're talking about two accounts here. Trade receivables or debtors account. We're talking about trade. We're talking about provision for doubtful. Provision for doubtful debts. Provision for doubtful. Provision for doubtful debts. Talking about provision. And of course, we are talking about bad debts written off is an expense account, right? Written off is an expense account. Bad debts written off is an expense. Is an expense account. Provision for doubtful debts is a liability account. And of course, trade receivables is an asset account. So do we have balance brought down from the previous year? We cannot tell, right? Balance brought down from the previous year, we cannot tell. We can maybe say it was 0, then we have sales, so credit sales. Credit sales will be bringing in money here, which is 82.50, right? 82.50. Remember this 82.50, it is after, so let's say, but we can talk about this one here being balance brought down, 82.50. Let's talk about that. We do not know what happened during the year. So provision for doubtful debts, liability account, balance brought down. Let's explain this to Lillian here. So balance brought down for doubtful debts. Allowance for doubtful debts, we have 450, right? Then I have bad debts written off is an expense account. So that expense during the year, of course, it came from trade receivables. It came from trade receivables. So trade receivables here, bad debts written off, we have 1,100, which is already there. Good. Now, under additional information, we are told that trade receivables included 250 due from a customer who was declared bankrupt, right? Now, if someone has been declared bankrupt, we don't expect anything from them, and therefore we have to eliminate that from our books. So we are taking it to income statement as an expense. Under which expense category? Doubtful debts, or bad debts written off. So bad debts written off. How much was this person owing the company? 250. When I take it from this account, I'm reducing the trade receivables account by the same amount. I've created this account. I need to debit the expense account. Trade receivables is bringing in 250. It has been written off. Good. Then we are told that provision here. Provision for doubtful debts. During the year, we are told that the allowance for doubtful debts is to be adjusted to 5% of accounts receivable as at 31st of March 2023. So the balance carried down here in this account, it has to be adjusted to 5% of the net accounts receivable. Now, this account receivable is also supposed to be reduced by 5% being taken to provision. Provision for doubtful debts. So how much are we taking to the doubtful debts account? We are told that we are supposed to take 5% of the account receivable balance at the end of the year. This balance is supposed to be what we add minus what is supposed to be written off. So the net amount after dealing with all that is equal to 8,000. 5% of 8,000 is 400. I've credited trade receivables. I'm supposed to debit provision for doubtful debts. It is coming from trade receivables account. How much are we getting from that account? 400. We add 450. We are told we are supposed to adjust it to 400. Is it an increase or a decrease? It is a decrease. Or just look at the balancing figure. Where will I put the balancing figure? On the debit side, right? That balancing figure, whichever the case or whichever the side I'm going to put the balancing figure, it has to go to income statement. So if it is on the debit side, it is going to income statement as an income. If it's on the credit side, it is going to income statement as an expense. I've debited provision for doubtful debts account. To balance the account, I need 50, right? Now, this 50 is going to income statement, which means income statement which will be credited. When I credit income statement, what has happened? That is an income. When I debit income statement, what has happened? That is an expense. And that's where we are getting this decrease in provision, 50. That's why we're getting this 50 from decrease in provision for doubtful debts. Is it now clear? Is it now clear? We've now known again, I want to balance the trade receivable so that if I go to statement of financial position, I will know what to record as the balance carried down of trade receivables. So debit is more than credit. It means our balance carried down will be on the credit side. So let's balance the account. Let's balance the account. Let's balance the account. So what do I need to make this account balance here? I need something like, is it 7,600? Is it 7,600? Yes. So it means my trade receivables will be 7,600. Will be 7,600. Is it now clear? Is it now clear to all of us? Is it now clear to all of us? Please confirm, please confirm. Good. So remember, some people have not decided to join the classes. Look at what you are missing. We've already started covering this syllabus. So if you wait for the results to be released, you're going to lose a lot. You'll just be following videos of what was done instead of following it live and asking questions instantly. So please don't wait for the results to be out. Just do a commitment fee of 1,200 and join these classes. Once the results are out, you will know where to get to. If it is positive, of course, we know it should be positive. Basically now, be here with authority doing your BDA. If it is negative, of course, your 1,200 will not be retained. It will be taken to reduce your amount payable for the other units. It's just helping you to commit as you join the class. If you're going to go to the advanced level, you just take your 1,200 and use it to reduce your fee for the advanced level. If you get to BDA, we will not charge you extra amount. No, if you are to pay 9,000, it means your total fee will be reduced by what you already paid as commitment fee. So that's what is there. Any details with regards to joining the class? You just need to do the payment to this pay bill 839. That is our pay bill Account number, we are talking about business data analytics. So account number will be BDA. Your commitment fee is 1,200. Your commitment fee is 1,200. Any inquiry, any information, just reach out to these two people here. Any inquiry, just reach out to these two people here. They will assist you. They will assist you to access the classes. So just do the payment and then you get added to this particular class. Of course, we have the option of early morning and evening classes. So if you cannot make it to the evening classes, you have the option of joining the early morning class. Where have you gotten 8250? Oh, okay. So that's what we have there. Lillian is not seeing 8250. Please help us get to this figure. Accounts receivable. Accounts receivable. Accounts receivable ndio hii hapa. Accounts receivable ndio hii hapa. Accounts receivable. Yes. All classes were started last week. All classes began on 2nd of March. So imagine up to date, you've not decided to join the classes. You may be waiting for next week. When will that be? Around 21st. Around 19th. So between 2nd to 19th, you will find that people have done a lot of things in between here. Good. Let's move to the next thing. After total income, we need to look at expenses. Expenses. Now, the simplest way of dealing with this, please go to additional information. Anything in the additional information, deal with it so that when you now get to your trial balance, you should have captured a lot of things. So number 1 has been utilized. Number 2 has been utilized. Number 2 has been utilized, but we are being told included in this, we have 250 due from a customer who has been declared bankrupt. So bad debts written off, which is an expense, we already have 100 here, right? And we are adding 250 at the end of the year, which was still part of this 8250. So it means our new bad debts written off itakuwa ngapi? Our bad debts written off itakuwa ngapi? The existing 100 plus 250, right? The existing 100 plus 250 from accounts receivable. Good. The next thing under additional information, we are told that admin expenses accrued. Then you also have prepaid selling and distribution. So let's come and take admin expenses, selling and distribution. Let's take these items here, those expenses, because they are affected. So admin expenses, what are they saying? We already have this admin expense, right? What has happened to the admin expenses? We have accrued. Accruals increases the expense amount. So how much was accrued? Accrued 175. Don't bring 175,000 because the figures are in thousand. So just bring 175. That is admin expenses. How about selling and distribution expenses? We have this. What happened to the selling and distribution? We add selling and distribution expenses were prepaid to the tune of 75. So what do we do to do with that? We need to deduct prepayments, reduce our expenses, accruals, increase our expenses. So that's what we need to, that's what we are having. Good. The next thing under additional information, the company paid interest on the debentures for the year ended 31st March on 5th of April after the end of the financial year. So interest on debentures or finance cost, we can call it finance. Finance costs. So finance cost here, do we have the debentures? Yes, it is 8%. 8% of this is supposed to be 200. It was paid after. So remember, we also have what we call accrued finance costs, interest payable. So here we have prepayments, we have accrual, we have payable or accrued expense. So this one here will be taken to the statement of financial position. So we have these three items that contain some information to be taken to statement of financial position. Good. The next item here, we have depreciation is to be provided as follows. Building 2% per annum. So we have depreciation on buildings, depreciation on buildings, depreciation on buildings here. It is 2% on costs, 2% on costs. So depreciation, the cost is the building, its cost is there, right? Its cost is there. Then we also have depreciation on fixed, is it 2%? Yes. Depreciation on fixtures and fittings is 10% per annum on reducing balance basis. So depreciation on fixtures and fittings, depreciation on fixtures and fittings is equivalent to 10% on reducing balance method. So it means it is 10% of net book value. How do we get net book value? It is the cost of fixtures and fittings minus its accumulated depreciation up to the beginning of the year. Accumulated depreciation of fixtures and fittings as at 1st of April 2022 is equivalent to 1,400. So when you do that, you'll be able to get the net book value. And from the net book value, we take 10% as depreciation expense for the current year. Good. After that, do we have any other assets? No. The company's directors propose that the preference dividends be paid. So the dividends of 10% on ordinary share capital be paid, this one here. I actually want us to deal with this by preparing what we call statement of changes in equity. By preparing what we call statement of changes in equity. I think it will enable us to get something. Statement of changes in equity. Good. Having done that, do we have any other expense? So these are additional information, right? Now, after looking at the additional information, let's now get back to the trial balance and look at all these items one by one. If we have any expense which was not interfered with. So let's look at it from the topmost part. These ones are capital, liabilities, assets. This one income statement item has been used. Purchases has been used. Bank overdraft, that is a balance sheet item. Discount received, that's an income that has been taken care of. Discount allowed is an expense, right? So we have discount allowed. So we now come and bring them here since they have not been affected. We have building, that's an asset. Fixtures and fittings, an asset. Inventory, no, we are not going to use it there. It has been used. Return outwards has been taken care of. Director's fee. Director's fee. It was not used, so we need to bring it here. Then we look at admin, has been taken care of. Selling and distribution, we've taken care of that. Bad debts written off, we've taken care of that up here. Allowance for doubtful debts, it was already taken care of. Investment at fair value, that's financial assets, right? Investments at fair value. So this one here, we don't have any adjustment under additional information. Retained earnings or profit at the beginning of the year, it has not been affected. We'll be able to see that under statement of changes in. So let's look at profit for the year. Profit for the year. Profit for the year. So let's get summation of all the expenses. Summation of all the expenses here. summation of all the expenses. So we come here and add all these expenses here. It will give us 10,510. Then to this we get profit for the year. We don't have tax, right? They did not mention anything to do with the tax. So you should not force tax here to be 30%. Should not insist that we must pay something to Zakayo, even if the examiner has ignored that. Don't force the examiner to do payments to Zakayo. Good. So let's have our profit for the year. We can put this as a negative if you decide. Then you now give us the profit for the year. Profit for the year. This is what we have. So are we all getting 13,865? Are we all getting 13,865? Are we all getting 13,865? Confirm before we get to the next step. Are we getting the same thing? Are we getting the same thing? Please let me know. Are we getting the same thing? 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 Great. So if you're getting the same thing, so let me just introduce this as early as today. We want to look at statement of changes in equity. Statement of changes in equity. Statement of changes in equity. So our statement of changes in equity here, we are going to have some important columns here. We are going to have ordinary share capital. We are going to have retained or share premium. We're going to have share premium. We'll be having retained earnings. Retained earnings. We will be having what we call revaluation reserves. Or fair value adjustments. Reserves. We'll be having revaluation reserves. We are going to have general reserve. So if they don't use the word retained earnings, we'll find them indicating retained earnings, accumulated profits, revenue reserves. So those are basically referring to retained earnings. So let's have these ones here. Let's have these ones here. Good. Now, we come and list all of them. We come and list all of them here. So we have ordinary share capital. So we have balance. We have balance brought down. So do we have balance brought down for the ordinary share capital? Balance brought down. This is it. Do we have share premium balance brought down for share premium? Do we have that? Yes. How about retained earnings? Do we have balance brought down? Yes. Do we have revaluation reserves? Revaluation reserves, let's check. Revaluation reserves, we don't have any there. So just write 0. General reserves, do we have opening balance? Opening balance for general reserves, I doubt if you have any. Opening balance for general reserves. We don't have any. Good. Now, profit for, so let's say we have profit for the year, which will be taken to this statement of changes in equity. So yes, we have profit for the year. So profit for the year. So our profit for the year, which account will it affect? Is it retained earnings? Is it share premium? Is it ordinary share capital? Which account will be affected? Which account will be affected by profit for the year? Which account? Retained earnings, right? So our profit for the year will be taken to retained earnings here. And how much is it? It's a positive figure, 13,865. Good. Now, after profit for the year, we now come and look at some additional information here. They are talking about dividends. So preference dividends here. Talking about dividends of 10%. So, okay, we're talking about dividends of 10%. So let's have dividends. Our dividends here will be, again, reducing our retained earnings, right? Dividends will be reducing our retained earnings because there are expenses. We are paying this to shareholders. So dividends here will be 10% of, will be 10%, 10% of ordinary share capital, 10% of ordinary share capital, right? 10% of ordinary share capital. Then we also have for preference share capital, we have 10% of what? Of 2,500. 10% of 2,500. Good. So this dividends, remember, it is an expense. So we need to indicate a negative for everything there. We need to indicate a negative for the outcome. Good. Having done that, any other thing, we have what is supposed to go to general. General reserves. We have been told we are supposed to take 2,500. We're supposed to take 2,500 to general reserves. So we need to have a column here for the total. And of course, we also need to have total row-wise, total row-wise. So the simplest way of dealing with this, just highlight everything here. 1750 metoka wapi? Well, highlight all of this, then you say alt equal. Highlight all of that, then you say alt equal. We are taking dividends. Remember, we have two types of dividends here. We have the one for preference share capital, and we have the one for ordinary share capital. Ordinary share capital. Now, our treatment of these dividends will depend on something here. And let's agree on how we are going to deal with the preference share capital. The preference share capital provided here, is it an equity? Is it a capital or a liability? Let's see. Preference share capital. Is it a capital or non-current liability? Is it a capital or non-current liability? Somebody to help us there. It will determine how we are going to deal with it. It will determine how we are going to deal with the preference share capital. Or somebody telling us this capital. If that is the case, under what circumstance will we consider preference share capital as non-current liability? When are we supposed to consider that? When are we supposed to consider preference share capital as non-current liability? Somebody, it will determine what you are going to do with the preference share capital. And if it is capital, then we have to bring it here, right? Redeemability, okay. So somebody is telling us if this preference share capital was indicated redeemable preference share capital, it could have been taken as non-current liability. But because they have not indicated the word redeemable preference shares, we take it as share capital. We take it as capital. So are we agreeing on that? Are we agreeing on that? Are we supporting that argument, or somebody with a different version? Somebody with a different version? Somebody with a different version? Good. So are we going to create additional column for the share capital? So we're talking about, okay. Now, having done that, we have said we are supposed to bring it here as part of the, you're supposed to bring it here, right? So people are telling me we need to bring preference share capital. Preference share capital. So opening balance 2,500. 2,500, then we now get the total down here. And of course, the total preference share. Yes, so we are told we cannot combine the two, ordinary share capital and preference share capital. So we have to create additional column here. So addition column row-wise, this is what we have. Then column-wise, this is what we have. So your total equity, shareholders' equity is supposed to be 43,165. These are our shareholders' equity. That is ordinary share capital plus any other reserve, So for you to know how you're going to bring these reserves, everything you are having here, and it has got a balance. Anything you are having up here and it has got a balance must be indicated under shareholders' equity. So having prepared this account, let me just have this. Let me just have this indicated in this manner. Let's go ahead and prepare statement of financial position. Statement of financial position. Statement of financial position. So we should be able to have non-current assets. So non-current assets. So non-current assets, we're supposed to have PPE. Then we have intangible assets. We have investments at fair value. If you have financial assets, they are going to be taken to this part. So once you bring in these two, we'll be getting total. Then you get intangible assets here. If you have anything to do with goodwill, you get total and current assets. Then we come to this part and get current current assets. So our current assets here, we have inventory, we have trade receivables, we have cash and cash equivalents, cash and cash equivalents, that is cash balance, cash at bank, cash on hand. When we have financial assets. So financial assets, if it is classified under current assets, it is recognized as cash and cash equivalent. Good. So let's see, then we also have what we call prepayments. Prepayments here will be non-current, will be current assets. Then we get now what we call total assets. So let's see if we can get some of these things. So non-current assets, we record them at net book value. We record them at net book value. So let's have this. Let's have this. Our PPE, property, plant, and equipment. Property, plant, and equipment. So let's bring the cost. Property, plant, and equipment. So we're going to bring in these buildings here. We bring in fixtures and fittings. There are only those two, right? So those are the two assets that we are having there. Those non-current assets. Then that is at cost with less accumulated depreciation as at the end of the year. How do we get accumulated depreciation as at the end of the year? It is opening accumulated depreciation. So we less opening accumulated depreciation of land, of building. Then opening accumulated depreciation of fixtures and fittings. Then we add a depreciation expense for the current year of these assets. That is depreciation on buildings, then depreciation on fixtures and fittings. So total accumulated depreciation as at the end of the year is already captured by adding all the four items there. So once that is done, we'll be able to see that our PPE is 19,940. Investment at fair value, there was no revaluation. So just come and look for it down here. Investment at fair value, it is 4,000. So total non-current assets, you add the two. Inventory, closing inventory, we already have it somewhere here. Closing stock, this is it. Trade receivables, we add net. We were given 8250. We add to deduct 250, which was written off. We add to take 400, which was provision. So the net amount was 7,600. I believe you're able to remember this. If you can refer to the T account, if you can refer to what we did yesterday, you can see where we are getting 7,600. Then cash and cash equivalents. Are we having anything here? So we add bank overdraft, that's a liability, and nothing was paid to reverse this bank overdraft. So that remains to be a liability. Then we have something here is remaining. What do we have here? Prepayments. What was prepaid? We had some prepayments here. The administrative expenses were accrued. Selling and distribution were prepaid to the tune of 75,000. So that's a prepayment. So let's now get total assets. We can actually get total current. So let's get total current assets. Then move down to getting total assets. Total assets, we take total current plus total non-current assets. So we have 49,615. Then to this, we go to equity and liabilities. Equity and liabilities. So under equity and liabilities, we have equity. We start with equity, right? So equity here, we have ordinary share capital, and of course we have 10% preference. We have 10% preference share capital, preference share capital. So ordinary share capital, we have 15,000. Preference, we have 2,500. Then we add the two. Then we bring in what we call reserves. We bring in the reserves. So these reserves, that's where we have share premium. That's where we have retained earnings. That's where we have general reserve. So do we have this share premium, retained earnings, general reserve? Actually, come and pick the titles from the statement of changes in equity with balances. So ordinary share capital, preference share capital, share premium. Of course, the two are capitals. Then, I mean equity, share premium, retained earnings, revaluation reserves does not have any balance, so no need of including it there. General reserve has got some balance. Now, why are we getting the balances column-wise? Once you have this, you come and actually you don't pick share capital from this other account. No. That's a very big mistake. You don't pick it from here. That's why you are preparing the statement of changes in equity. If there was any paid in capital, if we issued more shares, then it means it led to increase in the share capital account or ordinary share capital. So you don't pick it from the trial balance again. We pick it from the statement of changes in equity. Even if the figure is the same, I should pick it from this point to tell the examiner that at least I understand what I'm doing. I pick it from this account, right? Then share premium, come and pick it from the statement of changes in equity. Retained earnings, revenue reserves. Remember, if I pick it from retained earnings, I am having 21,165. If you pick it from the income statement, you are having 13,865. So just look at the difference. Why are we having the difference? Because the dividends that were paid or declared, then we also have what was transferred to general reserves. They affected our retained earnings account. And that's why we have to take it from the statement of changes in equity. General reserves, it was not there in the trial balance, but if you go to statement of changes in equity, we have it down here. Good. So when you bring in capital plus these reserves, you'll be getting what we call total equity or shareholders equity, shareholders equity. Shareholders equity. Shareholders equity, you add everything there. Shareholders equity, you add everything there. Good. Having done that, we now go to liabilities, non-current. Non-current liabilities, we have 8% debentures. So what is the value of these 8% debentures? 8% debentures, we got it from this point. This is it. Any other non-current liability? I think is only that one. Good. Then we go to, oh, something is happening down here. Let me just take this down. Then we go to current liabilities. So current liabilities, we have trade payables, right? So we have trade payables. So from trade payables, we have accrued. Accrued, was it selling and distribution? Accrued, admin expenses. They are now liabilities. Accrued expenses are now liabilities. Remember, these people do not pay that interest. Finance cost payable, finance cost payable. Dividends was just proposed. They did not pay that dividends, right? So we have proposed or dividends payable, right? Good. Then we have bank overdraft. So let's come and bring the figures. Trade payables was not affected. We just pick it from here. Trade payables was not affected. Accounts payable, it was not affected. Accrued admin expenses, it was 175. Tuko nayo hapa. 175. Accrued admin expenses, 175. We have finance cost payable. Go to income statement. The all of it was recorded there, but they paid nothing. So we have 200. Then we have dividends payable. Total dividends was a liability. I go to statement of changes in equity. That dividends affected our retained earnings, but I want to have it in positive form, so I just indicate that. Bank overdraft was not affected, so nothing was paid into the bank account to reverse this, so it is still retained. And that is it. So having done that, let's get total liabilities. Total liabilities. So total liabilities here, we get current plus non-current liabilities. That is giving us this figure. Then we do the final one, total equities and liabilities. Total liabilities and equity. Total liabilities and equity. So we just get the summation of liabilities and total shareholders equity and total shareholders equity and total shareholders equity. So once that is done, this is what we are having. This is what we are having as the total amount. Are we together? Are we together up to this point? Are we together up to this point? Are we getting the same thing? Are we getting the same thing? Are we getting the same thing? Please confirm. Confirm. Are we getting the same thing? Are we getting the same thing? Are we getting the same thing? Then I show you another concept here. Are we getting the same thing? Are we getting the same thing? Please let me know. Now, something was done, but we did not rectify. Look at our statement of changes in equity. We were taking some amount to general reserve, right? Where was this 2,500 coming from? We took 2,500 to general reserves. Where were we taking it from? Yes, it will be there. All the classes that will be done must be posted to LMS. It must be posted to LMS. So can somebody help me here? Remember, under general reserves, we took 2,500, right? To general reserves. Where was it coming from? Where was it coming from? Somebody is not following what we are doing. Where is this 2,500 coming from? We are taking it from retained earnings, from profit for the year, right? So profit for the year is here. We'll be increasing our retained earnings, which we have been able to do. But now, when you take this amount to general reserves, we must reduce it from the profit for the year. We must reduce it from the retained earnings. So it means our retained earnings is supposed to be affected. We're supposed to take 2,500 from retained earnings. We're supposed to take 2,500 from retained earnings. Right? Yes, from current year's surplus. So once you bring the profit for the year, we take dividends from it, we take general reserves from that account. And therefore, what is supposed to take to statement of financial position under revenue reserves or retained earnings is 18,665. 18,665. So let's look at that. So our retained earnings should be 18,665. Then we have general reserves. So our total shareholders' equity is 4665. When I add total equities and liabilities, this account, it must, not may, it must balance, it must add up or be equivalent to total assets. It must be equivalent to total assets. Is that the case? Is that the case with this particular question? Is that the case? Are we together? Are we together up to this point? Are we together up to this point? Are we together? Good. Having looked at that particular question, I want us to go to this interesting question, which was tested in April 2024. Even though their intention with that particular question is different from the concept we are covering, but you must have this knowledge. So if you go to April 2024, question number 24, April 2024, question number 24, I posted, this question was pasted or posted here. The question was posted here. So just go to quiz 1, that's what you are going to have. April 2024. If you go to the past papers, you'll get it from April 2024, question number 24. If you come to this document, it is here under quiz 1. So I want us to see what was presented here. The examiner wants you to prepare an audit schedule showing the following 4 sections, having debit and credit columns. So this one here, this question, this part, we are going to answer this when we get to audit section. When you get to auditing parts under topic number 4, we'll be able to answer this question or these ones here. But at this particular point, I want us to replace those questions. I want us to replace those questions, these ones here. Change it to required, change it to required. Let's pick what we are doing here. They wanted us to prepare statement of profit or loss and then statement of financial position. I want us to prepare these two. I want us to prepare these two accounts. Statement of profit or loss for the year ended. So when is the financial year ending for this company? When is the financial year ended? 2023. So 31st of December 2023. 31st of December 2023. 31st of December 2023. So for the year ended 31st of December 31st of December 31st of December 31st of December 2023, 31st of December. So let's prepare this 31st of December 2023, 31st of December. Yes, good. So let's read through this question and see what is presented here. You are a new audit client. Okay, sorry for that interference. Sorry for that interference. Of course, we have to start from this point. So when you get a question of this kind, you first of all go through it. It was tested on the concept of audit schedule. So majority are used to being given a trial balance. A trial balance. So here, they did not give you the trial balance. You have to prepare everything by yourself. Like what we have just concluded, you are given a trial balance, right? So here, we don't have a trial balance. We have to do every transaction from the start to the end, which means for every debit, we're going to do a credit until we complete everything. So you can do this using two different methods. Number one, you can apply the T accounts. You can decide to use the T. You can decide to use the T accounts. You can decide to use the T accounts or come up with the debits and credits column for the adjustments. So if you look at this, you'll be able to identify the key accounts which are affected. Under additional information number one, you are being told that Miriam opened a separate bank account for the practice and deposited 5 million as capital. In addition, she obtained a loan from the bank amounting to 5 million at an interest rate of 12% annually. The loan will be paid over a 5-year period at shillings 1 million annually, together with interest due at the end of each year. So this 1 million is the principal amount, not the interest. And interest here is 12% annually. So at the end of this particular year, they stayed with the entire 5 million which was borrowed. So it will attract an interest amount of 12% of 5 million. That interest, you debit it to income statement. And of course, if it is not paid for at the end of the year, we now take it to the statement of financial position as finance cost payable. Our bank loan here, our loan here will be 5 million at the beginning of the year. At the end of the year, you pay 1 million, which is the principal. So in your statement of financial position, under non-current liabilities, you'll be recording 4 million. You'll be recording 4 million. Good. Now, before when you look at so many things down here, let's just see additional information. Number one, what are some of the key accounts you are able to see which we need to open? With regards to additional information, number one, there are some key accounts which we've been able to identify. So which ones are they? Which ones are these accounts? Which ones are these accounts? So Miriam opened a separate bank account for the practice and deposited 5 million as capital. So which account? So we have bank accounts, right? We have bank account, ordinary share capital, okay. So the two accounts that we've been able to identify here, let me just take you to this side. So you have two ways of dealing with this loan account. You can come up with a column. Talk about debit, talk about credit, right? Then you indicate the names here. Another way, you can come up with the T account. So let's come up maybe with the T account to make our friends here understand what is going on. What is going on. You can put it, bank will be having a lot of transactions. So let's put maybe bank to have that space. So this will be our bank. That will be our bank. We are talking about capital. I can talk about this to be our capital actually. So this one here will be capital. This one here will be capital. Here. This one here will be capital. Let me just do away with that all the way to that part. Good. So capital account. Let's have this as capital account. So the first thing they did, they deposited money into the bank account of this company. And of course, that is the initial investment. So capital account, money is coming from bank, right? Money is coming from bank. How much are they depositing here? So, and deposited 5 million. Deposited 5 million. So we have 5 million being deposited here. We have 5 million being deposited here. So we are having 5 million coming from a personal bank account, from our money being taken to the bank account of the business. So that is capital, right? Then we now go to bank account of this business. We go to bank account of this business. We go to bank account of this business. So this is bank. When you credit capital, you debit bank. So money is coming to the bank account. Of course, now being taken to capital. 5 million. The next thing within that additional information, number one, they are talking about bank loan, right? They borrowed a loan. She obtained a loan from the bank amounting to 5 million. So we have loan account. So let's come and take here bank loan account. Bank loan account. So we have bank. Bank loan. Bank loan account. So bank loan account, these are liability, right? If they give you a loan, you are increasing the liability. So where will this money go to? It is taken to the bank, right? You are getting money, you are getting loan, and of course that is an investment. So where will the money go to? Which accounts will be affected? Let me do away with this. Which accounts will be affected? When you borrow money from this bank here, they have borrowed you, they have given you a loan of 5 million. She obtained a loan from the bank amounting to 5 million at an interest rate of this. So where will the money go to? Which accounts? You know, somebody is now thinking or trying to imagine this money taken from the bank or as a loan. Somebody's also thinking like maybe capital. Let's see. So where will it go to? We are taking it to bank account, right? So increase in liability is supposed to be credited, right? So increase liability, we credit. So we credit bank loan by taking money to the bank of how much? 5 million. So let's come to bank and of course bring in bank loan account is bringing money worth 5 million. Good. That is additional information number one. Dealing with the interest here, that will be done at the end of the year. That will be done at the end of the. So this interest, it will attract interest of 12% per annum. We need to have finance cost account. Finance cost account. Let me just show you. If you decide to deal with the T accounts, this is what you are going to do to the last point. So here we have finance cost. So this finance cost is an expense, right? Finance cost is an expense. So they are charging interest of 12% per annum. So which accounts are we supposed to debit and credit? Which accounts? This interest will be paid at the end of the year. So it is not going to be payable. It will not be a liability. So let's get where the interest will be getting to. Which accounts will be affected? Number one will be finance cost. Then the next one, the other account to be affected. The other account to be affected will be which one? The other account to be affected, bank, because you're going to pay this particular interest. So we come and indicate bank here. How much is the interest? 12% of the amount which was borrowed. The amount which was borrowed is 5 million. 5 million. So when you borrowed 5 million, it's too much. 5 million, we are having 600,000 as the finance cost. this finance cost is paid and therefore it takes money from the bank account. We are talking about finance cost. Finance cost is taking how much from the bank? The same amount, that is 600,000. Good. Now, we are also told that they are supposed to pay the principal amount of 1 million at the end of each year. So it means our loan will reduce by 1 million. Where will this 1 million go to? We know very well it will affect bank loan, reduce it, which means we need to debit. So which other account will we? So bank loan, when you debit it, you are reducing that liability, right? So when I debit bank loan account, I need to credit another account. Which account will be credited? Which account? Debit bank loan, credit bank. So when I debit bank loan, I'm reducing the liability, right? How am I reducing the liability? By taking money from my bank account. So let me go to my bank account and talk about bank loan is taking money from my bank account of how much? 1 million. So I want you to compare the T accounts method and what we used yesterday to do the same. I want us to compare the T accounts method and what we used yesterday. Then you'll be able to see what is convenient. And of course, examiner will be specific on what to use. So we've been able to deal with additional information number 1 in totality. Let's go to additional information number 2. Miriam imported 3 dental equipments at a price of 600,000 each. There are 3 and each is 600,000. So that is 1,800,000 each, and incurred freight charges or freight insurance and port clearance costs of 200,000. The equipment is depreciated over 5 years. So we have what we call dental equipment. We have what we call dental equipment. So dental equipment here is a PPE. Dental. Let's just deal with that information only. Good. So this dental equipment, which costs are we going to capitalize? All the costs incurred to make this equipment ready for use will be taken as cost or will be capitalized as the cost of this particular equipment. So they are purchasing it, which means money is coming from our bank account to purchase this equipment. So we're going to debit equipment account by crediting bank. How much will we put here? We are told there are 3 equipments, right? There are 3 equipments and each was purchased for 600,000. That one was paid to the supplier. And we are told that the freight charges, the insurance added up to 200,000 shillings. So are we supposed to include that to be part of the cost, or we just leave it at 1,800,000? Should we include that to be part of the cost, or we leave it at 1,800,000? Somebody should advise us here. Will the value of equipment be 1,800, or we add 200,000? Or it is 1,800,000, then the other 200 will be taken as an expense, will be charged as an expense. It is 2 million, right? So we add any cost incurred to make this equipment ready for use will be part of its cost. So the company paid 2 million for this dental equipment. So let's go to bank. Remember, we took money from the bank account to pay for that equipment. So we are going to talk about dental equipment. Dental equipment, they paid 2 million. Good. That is additional information number 2. They are telling us that this equipment was depreciated, is depreciated over 5 years, which means depreciation is on straight line basis. So what we need to do is this one here. What we need to do is this one here. We need to come up with, so this one is bringing in a lot of things, copy. So we need to come up with the depreciation account and of course accumulated depreciation. So let's come and bring in depreciation. We want to bring it for all the items. We are going to have depreciation expense. Depreciation expense account, right? Then we are going to have accumulated depreciation, accumulated depreciation, accumulated depreciation. Now, let's do away with these balances that will copy it down here. So this dental equipment, we are maintaining it at cost unless we dispose, unless we purchase. We are not going to adjust anything in the name of depreciation. So let's come to depreciation expense. So this one will be taken to accumulated depreciation or provision for depreciation. So let's talk about provision, or let's just have the same word, accumulated depreciation accounts. We are going to take how much? Depreciation expense for the current year, we are told is supposed to take 5 years. So we are going to depreciate this asset. Its value is this one, divided by 5. So every year it's supposed to depreciate by 400,000, right? So accumulated depreciation, we don't have balance brought down. The company, this person started business in the same year. So balance brought down is not there, right? Whatever is coming from depreciation expense account, which of course is an income statement item. So we are going to have depreciation. Depreciation is bringing in how much? 400,000. Now somebody is wondering, how will we deal with this to the income statement account? Remember, this account here, this depreciation expense account will be closed to the income statement. Assume this is the only asset we could have indicated. We are going to indicate income statement. Then we have 400,000. So it will not have any balance, any closing balance. No, we take it to income statement. This provision for depreciation, we are going to close it and take it to reduce the value of the asset. Reduce the value of the asset. So that's how we deal with it. Now, that is dental additional information number 2, if I'm not wrong. Yes, that is additional information number 2. The last one for today, Miriam also bought other equipment for 1 million, furniture and fixtures for 2 million, and dental books worth 500,000. So we have other equipment, furniture and fittings, furniture and fixtures. So we have other equipment. So we have other equipment, dental equipment. We can have that other equipment down here. Then we have fixtures and fittings down here. Then we have dental books down here. So let's call this one here other equipment. Other equipment. We don't know what was taken from the bank. We have fixtures and fittings. Fixtures and fittings. Then we have dental books. Dental books. So how much was taken from the bank? Let's see. Other equipment. Miriam, number 3. Miriam incurred. Number 3. Miriam purchased other equipment 1 million. Fixtures and fittings 2 million. Other equipment 1 million. Fixtures and fittings 2 million. Right? All these items are affecting bank account, and of course dental books 500. 500,000. So I simply go to my bank. I simply go to my bank account, bring in here other equipment, that is 1 million. Then we have dental, we have fixtures and fittings. Is it fixtures and fittings or furnitures and fittings and fixtures, something of that kind? Then we have dental books. So here we have 2 million. Here we have 2 million. Then dental books, we have 500. So we've just recorded the purchase of these assets. Do you have anything in the name of depreciation? So both the equipment and furniture were to be depreciated over 8 years. Wow. So equipment and furniture were to be depreciated over 8 years. So here, let's see, assume accumulated depreciation is for all the assets. So we come to the depreciation expense here, right? We are going to take it again to accumulated depreciation. Remember, this one here is for dental equipment, right? This one here will be for other equipment, and of course, accumulated depreciation for fixtures or furniture. So the books, dental books, we are going to have amortization account and accumulated amortization. So here, other equipment, we are told it's supposed to take 8 years. So other equipment, this is the cost. It's supposed to take 8 years. Furniture, this is the cost. It's supposed to take 8 years, right? Now, all these are supposed to be taken to accumulated depreciation. So depreciation, let's create space here. So we have this amount coming from the depreciation. We have this amount coming from the depreciation. Good. Remember, the accounts are kept at cost. So you only interfere with the account if you are going to dispose any of the assets. If you are not going to dispose any asset, we don't interfere with the account. So dental books, you are going to have what we call amortization account. Amortization account. Amortization account. And of course, you are going to have accumulated amortization. Accumulated amortization. So here, amortization, we are told it's supposed to take how many years for the dental books? Number 3. Yes, number 3. The dental books has got useful life of 5 years, right? So we just go to 5. We just need to take 5 years. So here we are. Its costs, we divide by 5 years to get amortization for the current year. Then accumulated here, we don't have balance brought down, but we have charge for the year, which is coming from amortization. How much is coming from amortization? 100,000. So if I'm going to prepare income statement, I'll be taking this. I'll be taking this expense of 100. If I want to get the net book value of dental books, it is the cost minus accumulated depreciation at the end of the year. So that's how we deal with additional information number, additional information number 3. Additional information number 3. So when we meet tomorrow, I'll be able to again show you what we used yesterday. You just need to have a column. You just need to have debit and credit column. Debit and credit column. Then you give us the assets. So here, and then you do the adjustment. So we have the cost of these assets adjustment. You debit depreciation, you credit accumulated depreciation. Then at the end of the day, you'll be able to see the debit column and credit column are actually adding up to the same amount. So I believe that is what we had to cover today. That is more than enough for today. So just create time, go through the video and see what we did yesterday, what we've done today, so that when we meet tomorrow, we'll be able to see how we are getting these figures. So that's enough for today. Thanks for your time and have a blessed night.